Good day. This is the financial feasibility study description for a client who doesn't know what to do with her apartments. The process followed for the feasibility analysis is shown in the flow diagram below. With the market research, a forecast of the inflation rates for up until 2023 was found, and these are the inflation rates that we will be using for these calculations. The financing option for the repair costs and the initial costs necessary for this feasibility analysis were either a bank loan and a continuation of the original mortgage or remortgaging the apartment. A bank loan was taken for the bank loan shown is for option 1, taking the initial costs of option 1 into consideration. An interest payable over the 5 years of 16,587 Rand is found. The continuation of the normal mortgage still has interest payable for 454,888 Rand. Remortgaging the apartment would result in a 705,272 Rand interest payable, and thus the bank loan is chosen as the most feasible solution. The estimated property value at the end of the period is calculated using property appreciation at a 4.45% per year increase. The value of the property is thus 1,150,000 Rand. The agent takes a commission of 7.5% on the sale, and the calculations are shown below. Deciding whether or not to buy the stove with the initial costs are evaluated by firstly adding the cost of the stove to the initial loan amount and looking at the interest payable versus the interest payable with just without the stove. There's a 2,000 Rand difference in the interest payable over 5 years. Looking at the interest that it accumulates after 1 year, it's only 60 Rand. Thus, the stove will only be bought in the first year. Rates and taxes and the levies were calculated using extrapolation of the data given in the project brief. They were then increased according to the average increase taken from the extrapolated data. The maintenance cost for option 1 and 2 is taken at 7,000 Rand per year for an apartment that's rented out, and this cost is then inflated to match the inflation rates given in the first slide. Deciding whether or not to replace the carpets with laminated floors, the cost is measured against the income that can be generated with the 800 Rand increase on the lease. It is shown that the income generated exceeds the payment of the carpets, and thus the carpets will be implemented for option 1. The initial costs for option 1 is then given as 52,000 Rand. The rental income is once again done through extrapolation. With the increase, it is also less than 8% per year, and the yearly revenue is then calculated. The agent fees for renting out the apartment is 75% for the first year's rent, for the first month of the year's rent, and as also shown. Water and electricity is paid by the renter themselves. For option 2, the Airbnb platform will be utilized since they have the lowest platform rate, and they also cover the apartment with insurance. The rental income and the apartment downtime is found through case studies on Airbnb, the website itself, and the platform fees is 4% per booking value. These are all calculated and shown in the table below. The additional cost to consider for option 2 is the cleaning cost, that's 200 Rand per booking, and the water and electricity cost of 600 Rand a month on average. These costs are also inflated according to the rates given in the first slide. The initial cost can then be calculated, and the monthly loan and repayment of interest is shown in the table below. Option 3 shows the costs and the tax related to it. The agent commission is 7.5% on the sale of the apartment, which was shown also on the first slides. Tax is not relevant here because the sale of the apartment is under 2 million Rand, and thus capital gains tax cannot be taken. The interest rate of the investment is taken at prime plus 3.5%. The financial advisory rate is 3% annually, and the initial investment is calculated as the sale minus the agent fees minus the remaining mortgage that's given as 400,000 Rand, and thus we have an initial investment of 441,000. Using the interest rate and deducting the financial advisory rates, the investment is shown. The NPV is also shown, but this will be discussed later. For options 1 and 2, the before tax cash flow rates can now be calculated. These are shown in the table below. It's a summation of all of the previous calculations done. Depreciation is only relevant for option 2 for the furniture that is fitted in the first year. According to SARS, depreciation of furniture is calculated at 10% per year. The tax for option 1 and 2 is based on the salary plus the rental income minus the tax deductions according to the SARS rules and regulations. The taxable income is then found. Tax on the taxable income is calculated using the table in the right-hand corner that shows the rates for this year, or shows the relevant rates. Now the after-tax cash flows and net present values are calculated for all of the options. Option 1 has a net present value of 520,519 Rand. Option 2 of 602,608 Rand. And option 3, 648,461 Rand. The net present values were calculated firstly for the net present value is calculated for the based on the after-tax cash flow rates, and then it's calculated per year. The NPV analysis were used due to the time value of money characteristic. This means that 10 Rand now is more valuable than 10 Rand in 10 years. Thus, the investment with the highest value now will bring the highest value to the customer. The best NPV is found for option 3. The client should thus sell the apartment and invest the remainder after the deductions in an investment portfolio to ensure that her investment is successful and financially feasible.